Good morning and welcome everyone to the panel, New Administration, New Focus. Fair Lending, Fair Housing, Where are we going? My name is Ali Lederer and I'm the Director of Fair Lending at NCRC. As we are all aware, a person's zip code impacts all aspects of their life, including their schooling options, job opportunities, health, and wealth building. For years, federal policy created and perpetuated redlining and segregation. The Fair Housing Act and Equal Credit Opportunity Act, otherwise known as ECOA, are two laws that prohibit discrimination in the lending and housing arenas. Under the Trump administration, we saw significant changes to policies that impact people's access to housing, like the disparate impact rule and affirmatively furthering fair housing, also known as AFFH. 3 months ago, Joe Biden was sworn in as the 46th president, and we're starting to see some reversals of policies the Trump administration had implemented. Today, we have with us speakers from two prudential regulators, the Department of Justice and HUD, to speak about their agency's fair lending, fair housing enforcement, and policy focuses under the Biden administration. Our first speaker will be Vartha Hussain, who is managing counsel for fair lending enforcement at the Fed. Before coming to the Fed, she had worked at the DOJ.
Great, thanks, Ali. It's a pleasure to be with you all today. My name is Vartha Hussain, and I'm the Managing Counsel for Fair Lending Enforcement in the Division of Consumer and Community Affairs at the Federal Reserve. Just a quick disclaimer before we jump in. The opinions expressed in this discussion are mine and are not formal opinions of nor binding on the Board of Governors of the Federal Reserve System. Today, I wanted to discuss how the Federal Reserve supervises institutions for fair lending risk and share a few supervisory observations on redlining and fintech. I will also share information on how we solicit feedback and participation from organizations in order to enhance the Fed's understanding of issues facing consumers and communities. To begin with, the Federal Reserve supervises approximately 800 state member banks for compliance with the Fair Housing Act and state member banks with assets of $10 billion or less for compliance with the Equal Credit Opportunity Act and Regulation B. As part of our supervision and enforcement function, if the Federal Reserve has reason to believe that there is a pattern or practice of discrimination, we are statutorily obligated to refer the matter to the Department of Justice. The Fed has a rigorous fair lending supervision program, and we supervise banks for fair lending risk at every single consumer compliance exam. We review banks' practices to ensure that financial institutions under our jurisdiction fully comply with applicable federal consumer protection laws and regulations. The Fed considers fair lending as one of the most significant areas of risk for institutions because violations in these areas may cause substantial harm to consumers, as well as legal, financial, and reputational risk to the institution. So we take our responsibilities, both in supervision and outreach, very seriously. With that, let me turn to redlining and explain how we supervise for redlining risk specifically. I will also share a few supervisory observations in this area, including areas of emerging risk. To level set, the 2009 Interagency Fair Lending Examination Procedures define redlining as providing unequal access to credit or unequal terms of credit because of the race, color, national origin, or other prohibited characteristics of the residents of the area in which the credit seeker resides or will reside, or in which the residential property to be mortgaged is located. This definition of redlining can be distilled as unequal access to credit to residents or neighborhoods on a prohibited basis. But as a longer interagency definition indicates, redlining is a multifactored analysis based on evaluation of many risk factors, and the Federal Reserve considers all of the facts and circumstances in making a determination of a redlining violation. At the Fed, we conduct a risk-focused review of redlining risk consistent with the 2009 procedures. The risk factors that we consider will be very familiar to you. First, we look at the Community Reinvestment Act, or CRA, assessment area, to review whether the bank's assessment area appears to inappropriately exclude minority neighborhoods. We also consider the lending record, or whether the bank's record of HMDA mortgage lending and or CRA small business lending shows statistically significant disparities in minority neighborhoods when compared with similar lenders. We also review branching strategies of banks, meaning whether the bank's strategy for branch or loan production offices appear to exclude minority neighborhoods. Federal Reserve examiners also review whether the bank's marketing and outreach strategy appears to treat minority neighborhoods less favorably. Importantly, we also review whether there are any complaints by consumers or consumer advocates that would raise concerns that a bank is treating a certain geography differently on a prohibited basis. When we assess risk, we're looking at each of these risk factors in many dimensions. So for example, when we look at lending disparities, we're also considering how those loans look when mapped onto an institution's assessment area. We also consider supervisory information that's not contained in public HMDA data, such as a bank's business model and how they're managing risk. For branching, not only do we look at the locations of the branches, we look at whether there are differences in products and services between branches or LPOs, loan production offices, located in non-minority neighborhoods as compared to minority neighborhoods. For example, an institution may decide not to assign any mortgage loan officers in branches or LPOs that are located in minority neighborhoods, but assigns all of them in branches or LPOs located in non-minority neighborhoods. One emerging risk area for us and for banks is in the area of marketing and outreach, with the proliferation of internet-based marketing, which brings us to the broader topic of fintech and fair lending. The intersection of fair lending and fintech has been a hot topic for some time and for good reason. While digital platforms and artificial intelligence may offer great benefits for consumers and opportunities for financial institutions, these technologies can risk undermining equal access to credit if not thoughtfully implemented. I'd like to discuss specifically two fintech practices that carry fair lending risk if not closely monitored. First, targeted internet-based marketing, and two, the broader use of artificial intelligence and machine learning in the lending space. As I mentioned earlier, one of the emerging risks in the redlining space is the growing use of targeted marketing. The concern in this space is when a bank's digital marketing and outreach activities largely exclude minority neighborhoods, as well as potential minority applicants. There are unique risks that arise in this space, including risks from third-party actions by vendors and by partners. There are several specific ways in which redlining risk in the context of internet-based marketing and outreach can be elevated. These include using criteria that largely exclude minority communities and applicants. This can occur by using filters by geography, branch radius, income, loan amount, and current customer status. Another way in which risk can be elevated is when an institution or a lender uses criteria that would be considered a close proxy for protected characteristics. A clear example of such a filter is the lookalike audience filter that Facebook did allow at one point in the lending space. This filter permitted advertisers to target ads based on similar characteristics, including some that were considered protected. Utilizing an advertising platform that uses predictive analytics is a third and a pretty significant risk pattern. When a platform uses predictive analytics, that platform can independently exclude minority communities and minority applicants, even when an institution intended for its advertisements to have a broad reach. This means that despite what the intent is, a platform is still an important consideration when evaluating for risk because the predictive analytics themselves can target the advertisements in a discriminatory fashion. So when we are assessing redlining risk in internet-based marketing and outreach, we are interested in knowing which criteria or filters are being utilized, understanding whether the advertising platform utilizes algorithms or filters that could exclude minority communities or applicants. And we also ask for reports from vendors and partners indicating the reach of the bank's actual marketing and outreach activities. For further information on this, I'd refer you to an excellent article by my colleagues Carol Evans and Wester Miller called From Catalogs to Clicks, the Fair Lending Implications of Targeted Internet Marketing, which is available on the Federal Reserve's website as part of our 2019 Consumer Compliance Outlook publication. The second topic, and to talk on the fintech space, is artificial intelligence and machine learning. The use of internet-based marketing and outreach is nested in this larger practice of utilizing AI and ML in the lending space. The use of AI and ML raised concerns of algorithmic bias in two important ways. First, with respect to the data inputs, there is a concern that the data that an ML model, a machine learning model, is trained on may not be representative or that the data may reflect historical bias or disadvantages. The concern here is that using unrepresentative or biased data has the potential to automate discrimination. The second risk is, as with all models, there is a concern about discriminatory outputs or outcomes that may have a disparate impact, even if the individual inputs don't on their face raise concerns. A machine learning model adds another level of complexity because these models are often black boxes, which may draw connections between variables that would not be visible to humans or, more pointedly, to regulators. Additionally, when used in lending, these models raise questions about explainability and whether decisions made using them can comply with ECOA. The key takeaway on the general use of artificial intelligence and machine learning is that just the fact an algorithm is data-driven does not ensure that it's fair or objective. Keeping these observations in mind, how is the Federal Reserve obtaining feedback on these issues? I'm going to discuss 3 ways in which you can provide input, seek input, or raise issues with the Federal Reserve. The first relates to a request for information on artificial intelligence. On March 29th, the Federal Reserve, OCC, FDIC, CFPB, and NCUA jointly issued a request for information, an RFI, on banks' use of artificial intelligence, including machine learning. This was a long coordinated interagency effort, and it was crystallized in part by the Fed's Symposium on Artificial Intelligence that we held in January of this year, a recording of which is available on our website. The RFI acknowledges that the agencies support responsible innovation and that artificial intelligence has the potential to offer improved efficiency, enhanced performance, and cost reduction for institutions, as well as benefits to consumers and businesses. The purpose of the RFI is to understand respondents' views on the use of AI by banks in their provision of services with respect to appropriate governance, risk management, and controls over artificial intelligence, and any challenges in developing or adopting or managing artificial intelligence. Importantly, the RFI also solicits respondents' views on the use of AI in financial services to assist in determining whether any clarifications from the agencies would be helpful for financial institutions' use of AI in a safe and sound manner, and also in compliance with applicable laws and regulations, including those related to fair lending. I would encourage you to submit comment letters, and the Federal Reserve is looking forward to receiving feedback from a range of respondents, consumer groups and advocates, financial institutions, vendors, and the general public. The comment period runs through June 1st of this year. Based on the comment letters we received, the agencies will determine the appropriate next steps, and the agencies expect to continue to work together on any possible next steps. In fact, what the agencies should do in this space is one of the key points on which we're seeking input. Would additional clarification from the agencies be helpful? If so, what type and how? One way in which you can seek input from the Federal Reserve is through our innovation office hours. This is one of our other fintech initiatives that we've rolled out recently. We have innovation office hours happening across the country, and it's a great opportunity to seek regulator input on fintech practices. In December 2019, the Federal Reserve announced that it would hold a series of these fintech innovation office hours across the country to meet with banks and companies engaged in fintech practices. Those wanting to participate can sign up for 1-hour slots for discussions with Federal Reserve subject matter experts. This is a chance to ask the Federal Reserve questions about the use of fintech and where we can address issues through outreach, like our webinars, presentations at conferences, or in our publications. In 2020, we held office hour events in San Francisco, Cleveland, and Richmond. Recordings of these events are available on our website, and stay tuned for where they will be held next. Finally, another really important way in which the general public and organizations can raise issues with the Federal Reserve is through our complaint process. The Federal Reserve takes a broad view of complaints and has stated that complaints can include complaints to the Federal Reserve or an institution, concerns raised in CRA public comment letters, complaints to other federal or state agencies, and lawsuits by a private party or a government agency. Complaints can also include complaints generated through internet websites or social media and press articles raising concerns about a bank's practices. As I mentioned earlier in the presentation, the Federal Reserve reviews all complaints by consumers or consumer advocates that raise fair lending concerns, and it is part of our supervision process. More information on our complaints function can be found on our Federal Reserve Consumer Help website, found at www.federalreserveconsumerhelp.gov. With that, I want to thank Ali and the NCRC for the opportunity to be on this panel today, and I hope that my comments shed some light on the types of fair lending issues that the Federal Reserve has been focusing on. With that, I'll turn it back to Ali, and I'm happy to answer any questions.
Thank you so much, Vartha, for your remarks. It was really interesting. Our second speaker is John Seward, who is the Principal Deputy Chief of Housing and Civil Enforcement Section in the Civil Rights Division at the DOJ.
Thank you, Ali. Let me begin by commending the folks at NCRC for your steadfast commitment to advocating in support of policies promoting economic empowerment. Your very ambitious agenda for this conference is a powerful statement as to the breadth of issues affecting communities of color and low and moderate income communities. So what are the new priorities for DOJ Civil Rights Division? Where are we focusing our fair lending and fair housing enforcement efforts? Well, as many of you know, Kristen Clark has been nominated to be AAG for the Civil Rights Division. She has had her confirmation hearing, and we are awaiting her confirmation vote. It would be inappropriate and presumptuous of me to declare our new priorities, as this is the province of the new AAG for Civil Rights. But what I can do is discuss some work that we are currently doing and the continuing importance of that work. I will also share my thoughts on the importance of strengthening valuable partnerships to achieve our mission. More specifically, I will use my limited time to describe our sexual harassment and housing initiative, our redlining work, and describe the importance of synergistic partnerships. So it should come as a surprise to no one that after spending my entire career focused on housing issues, I believe that our homes are central to our lives, to our happiness, to peace, and to our family stability. For victims of sexual harassment by their landlords, there is no peace, there is no stability, there is no sanctuary. In October of 2017, the housing section launched its sexual harassment and housing initiative. Since then, DOJ has filed 21 cases, settled 8 of these cases, obtained over $3.5 million in monetary damages for victims, and nearly $200,000 in civil penalties. What we have learned through these cases is that women are more vulnerable to sexual harassment in housing whenever there is economic pressure. Often, the aggrieved persons in our sexual harassment cases have limited housing options for one reason or another. They may be single heads of households, they may have a spotty rental history or criminal record. Some may be recovering from addiction or be past victims of sexual violence. But very often, it is financial instability that landlords seek to exploit. So looking forward, there are a couple of reasons why we will continue to aggressively pursue these cases. Record high unemployment can exacerbate sexual harassment. There may be some reprieve for some people while eviction moratoria are in place, but as evictions begin moving forward, there's definitely a concern that tenants may be more vulnerable to this type of conduct. This is especially true of demands for sexual acts in lieu of rent or to stave off eviction. Tenants who lose their jobs and cannot pay their rent are likely to have few, if any, housing options. There is a concern that unscrupulous landlords will take advantage of these circumstances to sexually harass vulnerable tenants. And there is a concern that some tenants may feel that they have to submit to harassment or their families may become homeless. Finally, the pandemic may also be making people more vulnerable to sexual harassment in housing in other ways. For example, it may be difficult for a tenant to avoid a harasser when she is staying home more often. Friends or family members who might otherwise have visited frequently or spent the night so the tenant isn't alone may not be willing or able to do so. And it may be easier for a harasser to insist that the tenant or applicant meet him alone because of social distancing. Now, shifting to what we will continue to pursue on the fair lending front, the issue that is most central to increasing homeownership opportunities, building wealth, and strengthening communities is our redlining enforcement work. We have brought redlining cases in every administration, and so I can say with confidence that we will continue to bring these vitally important cases. President Biden's executive order on discriminatory housing practices specifically notes the many damaging effects that redlining and lending discrimination have on non-white communities, such as lower rates of home ownership and lower rates of wealth accumulation. The executive order affirms the Biden administration's commitment to eliminating housing discrimination and racial bias and to promoting diverse and inclusive communities. Now, every one of us understand that redlining is a stubborn and persistent problem. Despite being banned by the Fair Housing Act of 1968, decades of disinvestment have contributed to long-lasting effects for residents of formerly redlined communities. Numerous recent studies, including those by NCRC, have shown that over 80 years after the HOLC maps that we've become very familiar with, and 50 years after the Fair Housing Act outlawed redlining, the economic and racial segregation created by redlining persists in many cities. You all studied the connection of these redline communities to COVID-19 complications. So if you have a stubborn and persistent problem, then you need to have a more powerful response to combat such problem. So I expect that we will intensify our existing enforcement efforts to respond to this persistent problem. I often refer to the resolution of redlining cases as a triple win. Our consent orders strengthen communities, they create homeownership opportunities, and oftentimes increase the lender's profitability because they are making more loans to qualified borrowers. Several years ago, Bertha and I interviewed a school teacher who benefited from the down payment assistance portion of one of our consent orders. She was able to purchase her home because of the down payment assistance. She was the first homeowner in her extended family and described how her home has become the new hub of family activities. She told us that a number of her family members are taking active steps to become homeowners inspired by, her current situation. Her home appreciated quickly, and she described how the equity will likely provide the necessary income to pay for her son's college tuition. This is just one example of how our settlements can transform lives. She was one of approximately 3,000 borrowers who benefited from this down payment assistance fund. 2,400 of those 3,000 were first-time homebuyers. So connecting to the human story behind these settlement numbers reinforces our zeal and determination to bring these important redline cases. Let me close with a quick word about the importance of synergistic partnerships. Throughout your conference, you have been highlighting the daunting challenges of a myriad of problems facing communities of color and low moderate income communities. You have heard from countless government agency officials, politicians, consumer advocates, and private industry representatives describing their efforts to address these challenging problems. My challenge to every person attending this conference or later listening to this broadcast is to think about how strengthening partnerships can enhance our ability to achieve common goals. In fact, don't just think about it, but let's act to strengthen partnerships. I always say that multifaceted problems require multifaceted solutions. If we can create synergies through strengthened partnerships, then we can achieve so much more than scattered individual dedicated actions. Now, I cannot ask anyone to do something that I'm not willing to do myself. At DOJ, we recognize that we can achieve so much more by leveraging the resources of our U.S. Attorney offices nationwide than simply relying on the more limited resources of the Civil Rights Division. I reached out to our U.S. Attorney offices to discuss partnering with us in our fair lending enforcement efforts. The response was overwhelming. So I expect that we will be able to achieve greater fair lending enforcement than ever due to these force multiplier synergistic relationships. We must also look to see how we can strengthen our partnership with other enforcement and regulatory agencies. We have strong relationships, but we need to explore how we can build upon these relationships to increase government efficiencies and create greater synergies. So too with the interactions between government agencies and consumer advocacy groups. You all are on the front lines, and you see practices that we may not be aware of in Washington, D.C. We want to hear from you so that we can better direct our enforcement resources. In closing, we will not be able to eradicate the problems that have been so systemic and pervasive in one administration. But the victims of discrimination deserve our best, and we can do so much more through collective efforts than separately. Thank you for your time, your attention, and most of all, for your diligent efforts to make a positive change. Thank you.
Thank you, John, for your words. And I'm hoping that we will see a lot of triple wins in this next 4 years and really help impact and change people's lives for the better. Our next speaker is Janine Warden. She is currently the Acting Assistant Secretary for Fair Housing and Equal Opportunity at HUD. Before undertaking the Acting Assistant Secretary position, she was the Associate General Counsel for Fair Housing in the General Counsel's Office at HUD.
Thank you so much, Allie and NCRC, for giving me this opportunity to speak to you about HUD's priorities in fair housing enforcement during the Biden administration. I am very pleased that the first action that we were able to take in this administration was to announce that HUD interprets the Fair Housing Act to prohibit discrimination on the basis of sexual orientation and gender identity. This is a plain language interpretation that is based on the Supreme Court's decision in Bostock versus Clayton County, Georgia. In that case, the Supreme Court held that Title VII of the Civil Rights Act of 1964, which prohibits discrimination because of sex, incorporates a prohibition of discrimination on the basis of sexual orientation and gender identity. Since the Fair Housing Act uses essentially the same words as Title VII to prohibit discrimination because of sex, we're very pleased to say that HUD is open for business in receiving complaints of LGBTQ plus discrimination in housing and lending under the Fair Housing Act. The second issue I'd like to talk about has to do with rulemaking. One of the executive orders that the Biden administration issued at the beginning of the term related to racial equity and underserved populations. The administration also issued a memorandum directly to Marcia Fudge, our Secretary of the Department of the Housing and Urban Development, and directed HUD to take a very close look at the regulatory actions that had been taken during the last administration relating to disparate impact and affirmatively furthering fair housing. HUD has done that, and just a few days ago, we announced that we have submitted proposed rulemakings to the Office of Management and Budget for review and interagency clearance. I can't go into great detail about what those proposed rulemakings would involve, but I can share with you the title of the rulemakings at this point in time. The first, related to disparate impact, is a notice of proposed rulemaking, which is, according to its title, intended to restore a discriminatory effects test under the Fair Housing Act. The second is related to affirmatively furthering fair housing, and it, pursuant to its title, it indicates that it is proposed as an interim final rule to restore the statutory definition of AFFH and restore certifications. So I hope to be able to tell you more about that in the future. But at this point in time, I can tell you that we are hopeful that OMB will conduct its review quickly, and we hope HUD will be able to move forward on these issues. The COVID-19 pandemic has exposed a lot of inequities in society, and the disproportionate effect on African Americans and Hispanics and Native Americans is one of the sad outcomes of the pandemic. One of the things that HUD expects to do in the very near future is issue some guidance relating to the COVID pandemic and the Fair Housing Act. So stay tuned. Another area where we will be focusing our enforcement efforts relates to disparities and how we can bridge the gap in minority home ownership. Recently, we have begun receiving a number of complaints under the Fair Housing Act alleging discrimination in appraisals, particularly discrimination based on race. We are looking very closely at the issue of appraisals and how bias may find a place in the appraisal process. And this is going to be an area of attention for us. Homeownership is incredibly important since it's the way we traditionally build wealth in America, where there's a first-time home buyer who is then able to pass wealth down to the generations of the family going forward. Secretary Fudge has made clear that this is an incredibly important topic for us to focus on. So you can bet that this will mean that we're focusing heavily on fair lending going forward. Thank you.
Thank you so much. I do look forward to the guidance concerning COVID-19 and fair housing. And our final speaker is Frank Vespa Papaleo, who is the Principal Deputy Director of Fair Lending at the CFPB. Before going to the CFPB, Frank had worked at HUD for a number of years.
Thank you, Ali, and thank you to the NCRC for inviting us to participate on this very wonderful panel with wonderful people. Much appreciated. Before I begin, though, I do want to note that our disclaimer that this presentation is being made by a CFPB representative on behalf of the Bureau, though it does not constitute legal interpretation, guidance, or advice of the Bureau. As the Bureau awaits a Senate leadership confirmation, Dave Weggio is serving as our acting director. Acting Director Weggio has set his focus on two top priorities for the Bureau during his tenure. One is seeking relief for consumers facing financial hardship due to the COVID-19 pandemic, and two, addressing racial inequities in the financial services industry. As the Bureau shifts towards this new focus, we continue efforts to enforce federal consumer financial laws and protecting consumers in the financial marketplace. Our acting director, Weggio, has stressed that regarding COVID-19, we need to take swift action now in order to make sure that our actions help people in the middle of the crisis, rather than just cleaning up after the fact. As you know, protecting economically vulnerable consumers is core to the mission of the Bureau and a key reason why the agency was created in the first place. It is going to take urgent action for the Bureau to step up to this challenge. And as Acting Director Weggio has stated to us, one thing the Bureau is immediately doing is focusing different Bureau tools to address consumer harm and suffering to ensure that regulated companies follow the law, meet their obligations to assist consumers during this COVID-19 pandemic. The acting director has also stated that it is time for the Bureau to take bold and swift action on racial equity as the country continues to be in the middle of a long and overdue conversation about race. And as we all know, practices and policies of financial service providers have both caused and exacerbated racial inequality. Even as we work to prioritize these areas, of course, we're also continuing with all of the other work that we do. And this means that activity will continue across the Bureau. Among our other work, our supervisory activities will continue examining institutions, even as we do the follow-on work from prioritized assessments. Our enforcement team will continue monitoring for and responding to consumer protection violations, both related to and independent from those priorities that I listed. And our regulations team will continue moving towards and advancing our regulatory agenda. With regard to fair lending, I want to bring your attention to two interpretive rules that were released recently by the Bureau. The first one is regarding special purpose credit programs. Recent calls for racial and economic equity sparked interest in a 45-year-old provision of the Equal Credit Opportunity Act, which you referenced earlier, Ali, that sanctions what are called special purpose credit programs, SPCPs. These are defined as credit assistance programs for economically or socially disadvantaged consumers and commercial enterprises. And special purpose credit programs allow nonprofit and for-profit organizations wide latitude in designing credit assistance programs that both increase access to credit and provide favorable terms and conditions to economically disadvantaged groups. ECOA, which is the statute, and Regulation B, which is the regulation that implements the statute, prohibit discrimination on a prohibited basis in any aspect of a credit transaction. But the special purpose credit program provisions clarify that it is not discriminatory for-profit organizations to provide SPCPs that are designed to meet special social needs. So in December 2020, the Bureau issued an interpretive rule on special purpose credit programs. This was issued to address regulatory uncertainty regarding Regulation B, which implements the law, and as it applies to certain aspects of special purpose credit programs designed and implemented for for-profit institutions to meet their social needs. So in particular, ECOA and Reg B permit for-profit organizations to offer these special purpose credit programs to meet the social needs, special social needs, if it meets two criteria. One, that the program is established and administered pursuant to a written plan that identifies the class of persons that the program is designed to benefit and sets forth procedures and standards for how they will extend credit pursuant to that program. And two, that the program is established and administered to extend credit to a class of persons who, under the organization's customary creditworthiness standards, probably would not receive such credit, or who would receive it on less favorable terms than are ordinarily available to other applicants applying to the organization for a similar type and amount of credit. So the commentary to Regulation B, which clarifies that in order to satisfy these requirements, a for-profit organization must determine that the program will benefit a class of people who would otherwise be denied credit or who would receive it on less favorable terms. And this interpretation or this determination is made or based on a broad analysis using the organization's own research and data from outside sources, including from governmental reports and studies. So presumably they could use studies from the NCRC. I know you guys do that a lot, do a lot of research in this area. ECOA and Reg B don't require this kind of determination for special purpose credit programs that are offered by a nonprofit. So what I said earlier was just for-profit entities. Nonprofits have a less of an obligation and easier standards to meet this. And for them, it's for under Reg B also, there's a provision that the creditor, whether it's for profit or nonprofit, can affirmatively, if they follow these procedures and satisfy them, may affirmatively solicit or encourage members of a traditionally disadvantaged group to apply for credit, especially groups that might not normally see credit from that creditor. So the Bureau has called attention to creditors to think about using these opportunities to develop special purpose credit programs and to use affirmative advertising consistent with ECOA and Reg B requirements for this program. We think this represents a significant and an unheralded tool to address historical injustices and continuing racism that is systemic in the credit markets and more broadly in racial wealth inequity. So we hope that special purpose credit programs are an idea whose time has finally come. The second interpretive rule that we recently issued, similar to what Ms. Warden mentioned, under the Fair Housing Act, we, as the Bureau, just recently released an interpretive rule on clarifying that the prohibition against sex discrimination in credit under the Equal Credit Opportunity Act and Reg B also encompasses sexual orientation discrimination and gender identity discrimination. So we think this is a very important rule, and making it clear to lenders that they cannot discriminate based on sexual orientation or gender identity in the decisions regarding credit, the availability of credit. And this prohibition also covers discrimination based on actual or even perceived nonconformity to a particular sex or gender-based stereotype, as well as discrimination based on the associations of an applicant. An example of discriminatory sex-based or gender-based stereotyping occurs when a small business lender discourages a small business owner who appears at its office from applying for a business loan and tells the prospective applicant to go home and change because, in the view of the creditor, the small business customer's attire does not accord with the gender of that individual. That would be a form of discrimination. A creditor engages in associational discrimination, on the other hand, if, for example, it requires a person who applies for credit who is married to a person of the same sex to provide different documentation of the marriage than it would apply for a person who is married to a person of the opposite sex. Those are just two examples of the kinds of discrimination that occur in the extension of credit context under the ECOA, now illegal. The Bureau is similarly taking this action consistent with the decision from June of 2020 in the Supreme Court's Bostock versus Clayton County case, and which held it was a prohibition of sex discrimination under Title VII that does cover sex orientation and gender identity discrimination as well. So our interpretive rule took effect on March 16th, which is when it was published in the Federal Register of this year. And as we also announced in the press release when we sent out the interpretive rule, the Bureau will be in the process of reviewing all of its publications and examination guidance documents, and we'll update those and other materials as needed to make sure that this rule is implemented. So those are two big items that we have been focused on and will continue to. Another one, just very briefly, that we're very concerned about is bias and discrimination in appraisals, something that the Bureau, under the authority to look at ECOA, will continue to look into this area and monitor. And finally, just in closing, I'd like to sort of make a mention of a new report that was just released a few weeks ago in April during Fair Lending and Fair Housing Month, which is our Fair Lending Annual Report to Congress. And it highlights the Bureau's fair lending work for the calendar year of 2020. And as you know, that included a lot of COVID-19 pandemic related activity. Just a few highlights from that report, which is available online at CFPB.gov, is information about our supervision program, how we supervise lending institutions. And last year we conducted what we call prioritized assessments to gain a better understanding of responses by industry to pandemic-related challenges. We also announced in the report 2 fair lending related and public enforcement actions that were brought in 2020. We also talk a bit about tech sprints that we held, which brought together stakeholders from technology, from regulatory organizations, and other experts to develop creative and innovative solutions to compliance challenges, and to find emerging technologies and where fair lending laws can be better served. And we of course do a lot of community outreach and education programming, attending lots of outreach events to educate consumers and organizations and industry about their rights and their obligations under the Equal Credit Opportunity Act and other Bureau laws. and to hear their views as a way to inform our Bureau policy making decisions. So I want to just thank you again for the opportunity to be here. I leave, and I know it'll go up on screen, just a link to some resources that we have available on our website and throughout the Bureau's reach. We'd like to hear from you if you have any questions, thoughts, if you have complaints about institutions that are engaging in discrimination or other practices that are prohibited. Please file a complaint, and we look forward to your engagement going forward. Thank you, Ali.
Thank you, Frank. It was really interesting to hear you lay out the elements for a special kind of purpose, and hopefully financial institutions will listen and start implementing these kind of products for people. At this point, if anybody else has anything else to share, I'll do that, and then we will move on to questions from the audience. Welcome back to all of our. I seem to have a bit of an echo. I just want to say thank you again for your great presentations. We are going to do some questions. I will also like to say that we have a replacement for one of the panelists. Unfortunately, Acting Assistant Secretary Warden was unable to come for the live Q&A section right now. And instead we have Lynn Grosso, who is the Director of Enforcement at HUD. So thank you, Lynn, for attending.
Certainly.
My first question is for Frank. Can you provide some examples of ways the CFPB is helping to alleviate financial hardship for consumers due to COVID-19?
Sure, Ali. Thank you for the question. Our acting director, Dave Weggio, has written recently about the top 2 priorities that the Bureau would be focusing on to protect consumers. The first is relief for consumers facing hardship due to COVID-19 and the related economic crisis. And I am pleased to share a few highlights that we've recently taken over the course of the last few months. One is we've issued probably more than 50 blog posts and videos that now have been accessed by more than 3 million consumers. And these are materials available now in 8 different languages, including English. And they've been constantly updated to adapt to the changing dynamics of the law and new offerings from Congress. So those are available on cfpb.gov. So I encourage folks to take a look at that. There's also a lot of information on that website about scams. What kind of scams should consumers be looking out for, and how to protect themselves and their credit. We've provided resources on economic impact payments, as well as resources for small business owners who seek assistance using the Paycheck Protection Program, the PPP program from the Small Business Administration. We've set out materials to help students and parents of students understand their student loan repayment options during this crisis. And we've provided specific information to our vulnerable populations, including older Americans and service members and veterans, about things to look out for and what they can do. Interestingly, in the area of housing and mortgage challenges, where our concern is to keep people in their homes. So, for instance, we've issued just recently on May 4th a report on housing insecurity, which shows that more than 11 million families in America are at risk of losing their homes due to delinquent rent and mortgage payments. And that's available on our website. On April 5th, we proposed a set of rule changes for mortgage servicers to help prevent avoidable foreclosures once the federal foreclosure protections expire. On April 27th, we issued a final rule delaying mandatory compliance date of the general qualified mortgage, the QM final rule, from July 2021 to October of 2022. And then most importantly, we have, in partnership with a number of other federal agencies, including HUD, who's here on the panel, and others, we developed a number of resources and created a unified housing website to assist consumers access a wide range of financial resources and understand situations that they may be in and what they can do to improve their circumstance. It includes information for renters, tools for homeowners and mortgage borrowers, et cetera. And I encourage folks to take a look at those. We list everything on our Bureau website. And finally, something that our acting director has emphasized that I wanted to share with you is that we're trying to listen. The Bureau is here to listen and to hear you. If you have a problem with a financial product or a service, please submit a complaint to us at consumerfinance.gov/complaint. If you want to tell us about your experience with money or financial services, good or bad, there's also a link to the Tell Your Story portion of the website. And something called Your Money, Your Story is a link on our website where folks can tweet about your ideas and your experiences as well. And we monitor all that information to try to create new materials and be able to share valuable information. We do want to hear from you, and thank you for this opportunity to do that.
Thank you, Frank. Does anybody else want to add about how they're working to help consumers with COVID-19? Okay. John, you'd mentioned sexual harassment, an increase in sexual harassment cases due to COVID-19. And I was wondering what percentage do you know of, like, for that increase this year, as well as how are these cases differing potentially from previous sexual harassment cases that you've seen?
Yeah, that's a good question, Allie. Thank you for that. I wouldn't say that the number of complaints that we've received about sexual harassment has gone up during the pandemic, but in part, the pre-pandemic numbers were just way too high, period. And so what has changed is the stories that we hear during the pandemic. So for example, I lost my job, I can't afford to pay my rent, and now my landlord is sexually harassing me. I can't, I want to go in to look at a unit, but I have to go by myself because of social distancing concerns. And so the numbers are the same, the stories change a little bit, but I think that the thing that we're very concerned about is what happens when the moratoria on evictions is lifted, because then you're going to have a lot of people faced with the prospect of losing their homes, and these landlords potentially will try to exploit that inability to pay rent. And so that's what we're very concerned about. I gave a number of numbers in my previous remarks, but I like to emphasize that these cases are about people, and any number is too high of a number.
Yeah, that's very true. Feeling safe in a home is vital for all of us. Vartha, you had mentioned that the Fed is working on alternative data. So my question for you is can you give us some sense of how the Fed thinks about alternative data, both the benefits from a financial inclusion standpoint, as well as any fair lending risks?
Great, thanks, Allie. Can you hear me okay?
Yeah.
Awesome. So thanks for that question. Alternative data is definitely a hot topic in fair lending. And as background, alternative data, while there's no generally accepted definition, it refers to any types of data that traditionally has not been considered in the credit decisioning process. So the term can encompass a wide range, some that have an understandable relationship to creditworthiness and others that don't. From a financial inclusion standpoint, in 2019, the prudential regulators and the CFPB issued a joint statement acknowledging the potential for alternative data to increase financial inclusion. It could potentially increase and expand access to credit, and it can enable consumers to obtain additional products and more favorable pricing terms. From a fair lending perspective, what the Fed has said is that generally data without a relationship to creditworthiness may pose more fair lending risk, especially if the data are correlated with race or other prohibited characteristics. So, as for example, one way to think about it are just thinking about alternative data in categories. And when you think about the category of behavioral data, there can be some fair lending risk. For behavioral data, we have, we understand that there are some machine learning mechanisms and other types of platforms that may consider things like what type of browser you use, what time of day you're browsing, and that sort of data that really focuses on a consumer's behavior, may be seen as less related to creditworthiness, and therefore, if it also is correlated with a prohibited basis characteristic, it can raise some fair lending risk. On the other hand, if you think of a category like cash flow data that's looking at consumer payments, that type of data is generally that data are generally more in line with the traditional underwriting data that lenders use, and therefore may pose less fair lending risk. For these reasons, in the interagency statement, the prudential regulators and the CFPB also made clear that what will be key to managing any fair lending risk is a strong compliance management system that ensures that the data that are being used are actually related to traditional underwriting principles.
Great. Thank you so much. Lynn, can you talk to us about the most recent HUD conciliations?
Absolutely. Thank you. And I appreciate your flexibility so I can be here filling in for Acting Assistant Secretary Warden. Let me tell you that the department HUD is extraordinarily interested in the emerging public policy discussions in the area of real estate appraisals, and particularly interested in the intersection between fair lending and appraisals, and how discrimination in appraisals can be affecting the home buying process and for protected classes under the Fair Housing Act, but also how we can leverage our authority in this area to improve homeownership rates. So of particular interest, we have seen a number of complaints come in the last several months in this area. I think we all have taken note of media coverage in the area as well. We were able to enter into a conciliation agreement to address allegations from a Black homeowner who asserted that her property was significantly undervalued because of her race in the context of a home sale. We were able to reach a conciliation agreement with JP Morgan Chase Bank on this issue. We still have open investigations related to that matter with the appraisers involved, but we were able to secure a sizable monetary award to the homeowner who asserted these claims before us. I think you can stay tuned and see as we start to flex our muscle in this area. I think we're looking at expanding our capacity and perhaps looking at some areas that we can really leverage HUD's Fair Housing Act authority in the area of appraisals. Also, I'd like to mention we also entered into a conciliation agreement recently with Wells Fargo Bank, and this concerned a customer's allegation that Wells Fargo denied her loan after learning that the loan was for the purchase of a home that would be used as a group home for persons with disabilities. We were able to secure a $125,000 award for the woman and also secure training for employees, including home mortgage consultants, managers, and underwriters. So we're really pleased with that. HUD has, over the years, done a number of significant conciliations in this area, particularly of qualification for mortgage loans. We've been able to address discrimination against people with disabilities. We've been able to address discrimination on the basis of familial status, where we've had borrowers who have availed of themselves of parental leave, which happened to be around the time of the loan. And I think you can continue to see HUD's work in this area.
Great. We look forward to seeing all that. As we have another minute left, I just want to open it up to anybody if there's anything else they want to add, any last thoughts to this panel. All right. thank you all for your time and for the information. It has been a fantastic, informative hour. And I hope to hear great things coming out of all the agencies and the prudential regulators very soon. So thank you again for everything.
Thank you.
Thank you, Allie.
Thank you.